today's volatile time, it's more important than ever to have the tools you need not only to survive, but to thrive in uncertain times. Options can offer a great way to protect your portfolio, generate income, and take advantage of big market swings. My name is Patrick Fisher, and I'm a financial advisor at Coastwise Capital Group, where we have decades of combined experience using options to achieve various investment and trading goals. In today's episode, I'm going to teach you about one of the most effective tools to generate income and provide some downside protection, the covered call. Let's look at how covered calls work by examining a $50,000 portfolio. At its starting point, your portfolio shows $50,000 of cash and no other positions. In order to get some equity exposure, you buy 1,000 shares of a broad-based ETF trading at $48.58. Now your portfolio shows a long position of 1,000 shares of the ETF at $48.58 for a total value of $48,580, plus $14.20 of cash. In order to generate income to provide some hedging, you sell short 10 out-of-the-money calls, specifically the $50 strike price calls for $3.20 premium per share. What does your portfolio look like now? After the sale of the short calls, $3,200 of cash is deposited immediately into your account, so that your cash balance is now $46.13. There is also an offsetting debit to the account, specifically a short position in the amount of $3,200. This short position with a negative balance is just like any other position in your account. Three possible outcomes exist from this position. The ETF stays flat, the ETF closes below the $50 strike price, and the ETF closes above the $50 strike price. Let's examine each scenario. If the ETF price is still $48.58 per share at the time of expiration, then the short position will be worth zero, up from $3,200, and you will have collected the premium as profit. At this point, you can elect to sell additional option premium via later dated options or hold on to the position unhedged if you feel its capital gains prospects are sound. If the ETF price is below $48.58 at the time of expiration, you still have made $3,200 from selling short calls and simply have an unrealized capital loss on the equity position itself. However, if the ETF is trading above $45.38 per share, you're still ahead on the total position, as the $3.20 of premium reduces your break-even point to $45.38, and in any case, you're better off for having sold the calls. Finally, the stock price could be above $50 per share at the time of expiration. In this case, unless you close out or buy back the option prior to expiration, your stock will be sold or assigned, and you will have gained $1.42 per share or $1,420 on your equity, in addition to the $3.20 per share for the covered calls. If you found this information helpful and want to learn more, please register for our upcoming webinar by clicking the link below.